Welcome to Real Talk, real estate discussions with Andrew Kirsch. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background, and unique career highlights, and guidance for newcomers to the industry. You can find this show at www.sklarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsch.
Welcome to episode 11 of Real Talk. I just got back from the IMN Real Estate Private Equity Conference in Laguna Beach, and safe to say, no one is doing deals. Anyone who says they're busy, they're just going to conferences each week, or perhaps they are reviewing deals just to keep up with the market, but they know they aren't going to be doing those deals that they're reviewing. Now, there's two schools of thought. I talked to one leading broker of the West Coast who says, at least with respect to office, that the pain that people are feeling is worse than what we suffered through during the GFC. Others feel that given the fact that there is so much capital on the sidelines waiting to just pounce once there's price discovery, that we aren't going to have a repeat of the GFC. It's probably both are right. It really depends on which asset class you're transacting in, which locations you're transacting in, and that'll determine the amount of pain. But as we sit here towards the end of January 2023, it is completely dry of transactions. Now, I'm really excited for our next guest, Zamir Kazi, the founder of ZMR Capital. Zamir has quickly become one of the most active owner-operators of multifamily throughout the United States, focusing on the Southeast and in the Southwest. Not only is he probably one of the tallest professionals in the real estate industry, his success story is one that really deserves having a full conversation with. He went from Division I college basketball player to pre-med to working as a server at the Red Lobster to selling vacation rentals to now having $1.5 billion under management. Let's go to our conversation with Zamir. All right. Welcome to another edition of Real Talk. I'm here with one of my faves, and I don't say this about everyone, Zamir Kazi, CEO of ZMR Capital. Zamir, how you doing, man?
What's up, Andrew? Thanks for having me, man.
Absolutely. So where does this podcast find you?
I am in LA, good old, not sunny, rainy cyclone bomb or bomb cyclone, whatever they call it, Los Angeles right now.
I know. I remember back in like November, December, seeing just sort of like the long-term forecast to see like what type of ski season we'd have. And they said, oh, this is going to be a drier winter. I would say this has to be one of our rainiest winters I could ever remember.
It's been raining for like 4 days straight. And you know, what's happening up in the Bay Area. I didn't know what a bomb cyclone was until today. I had no idea. So learn something new every day.
Yeah. Well, let's see. My most important, not most important, but my first question, just to get it out of the way, me being, 5'7", and that's really on a good day. I may have shrunk a little, and I know you're a little taller than I am. So how tall are you? Not that everyone can see you on iTunes and Spotify, nor can they see you standing on YouTube.
Well, my biggest weapon or surprise attack is not telling people how tall I am, and when they see me, it's the element of surprise. But I will indulge the information here today. 6'7", just a little bit over a foot taller than you, Andrew.
That's what I thought. So have you been in a room full of real estate professionals where someone is taller or as tall as you?
I don't think so. Couple of my buddies just started a fund with TPG and Josh Childress.
Oh yeah.
Yeah, he's tall, right? So he'd probably be the only person that I've met that's taller than me.
But if I recall, you're not a basketball player, you were a volleyball player, right?
No, I walked on the Florida State basketball team.
Oh, you were a basketball player. Okay.
I can't hit a volleyball if I would try.
Okay. I think it's, I think Brennan Degner of DB Capital.
No, I don't.
Okay. I think you guys are the same height. Also
Oh, really?
a great friend and client, and you guys do similar things.
You,
And I think he's the volleyball player, and that's right. You're the basketball player.
You can't put us in a room together because I got to be the tallest guy,
Yeah. You got to keep you guys. All right. Well, I'm sure everyone that's it for the show. So thank you very much for coming on.
There you go.
So look, Zamir, this is interesting times, obviously. I mean, the second half of 2022, volume has slowed down. As we're sitting here, we're taping at the first week of 23. Well, first, talk about what you guys do, what ZMR Capital does, and then I want to get into what we're seeing in today's market.
Yeah, so we do value add core plus multifamily acquisitions throughout the Sunbelt states, institutional size with institutional partnerships, and have been pretty active, right? Up until I would say the world changed 7 months ago. We closed on probably $1.5 billion of deals in a 12-month time frame, and the market has made a 180 in terms of capital markets, and that's us in a nutshell.
Yeah, well, I would say that over the last 2, 3, 4 years, I don't think I have a client that has really come on to the scene like you guys, like ZMR, where and I'm not just saying it just because you're on, but whether it's during YPO conferences or real estate conferences, people will ask me, "Have you heard of ZMR and Zamir Kazi?" And I'd say, "Yeah, I do a lot of their legal work," and so I'm proud to say that, and I just know that of how active you guys have been. I want to talk about how you started and how you grew ZMR, but I think what's on everyone's mind right now is what you've been saying like the last 7 months of how quiet it's been. What's your take on where we sit today, and what will it take for there to be price discovery and for there to be, I'm not saying the same amount of transactions like 2021, because that probably was inhumane, but a level of transactions like there was, say, pre-COVID?
Yeah, it's a great question, right? And I think it's kind of the $1 million question, because I think kind of when all this stuff was happening last year, after April, it kind of, we didn't know how long this was going to last. And I think then optimistically, we were thinking, okay, after Labor Day, things are going to change. And then, they didn't. And then I think everyone was like, okay, first of the year, things will change, and they're not, right? And I think I have a sense that most groups out there have a sense largely where the market should be, I think, right, in their head. Now, if the Fed continues raising rates and they don't stop when we think they're going to stop, then I think that all changes. And I think we've all seen that everything that we've assumed and the curves have all been wrong, and so none of us have a crystal ball. But I think the bid ask right now is still just too wide, and I think it's going to take the Fed to clearly say, "Hey, we're done. Right? This is it." And I think once the Fed does that, then I think everyone can then go out and largely, have some confidence that, okay, this is where we're going to underwrite deals. This is where we're going to underwrite exits. This is how, we can actually, we're not guessing anymore.
Yeah.
Right? But until that happens, I don't see, people don't want to catch a falling knife right now. And I think, we've tried to sell deals in this market, and it's just impossible almost to find qualified buyers, and debt's just ever changing. So it's just, they're unprecedented times, right? We've never seen interest rates climb this fast before, and this high in such a short period of time. And I think a lot of people are betting on the fact that deals will get better and there's going to be more blood in the water, right? So I think it's a why would we trade now and act early if the deals will get better, right?
So if you're saying there's really like no price discovery and the bid ask spread is too wide and sellers are still looking at the value of their real estate or what it was just 6-7 months ago, and like you said, you've been trying to sell, even if the Fed stops raising rates, which they will in the next couple of months or quarter and a half, when will sellers get the message and realize that cap rates have increased substantially since the second quarter of 22?
And I think that's where the problem is a lot of these sellers, right? Look, and us included, we've purchased properties at 3 caps in the last year, right? So if now your property is a 5.5 cap, your values have dropped tremendously. So you need time to increase the NOI. And I think operationally and fundamentally, the industry is still strong, but you're going to need time to get to there. So now where you're buying deals and flipping them in a year because cap rates were compressing, that's just no longer the case. And I think you'll have to actually execute and see those business plans through. But also, I wouldn't want to sell deals unless we absolutely had to, or we were in the money and we bought them, years ago, right? So I think what's going to happen is most people, or a lot of people, used debt fund debt over the last few years, and there's 3-1-1 deals, and we'll start to see situations where sellers are going to have to sell, right? Because instead of doing a cash in refinance, and maybe then, at that point, then sellers have to be realistic, right? But until that starts to happen, I think, it has to be circumstantial for people to say, okay, we'll sell at, this cap rate or this price.
And for some of our listeners who may not be as familiar with the type of bridge debt that you're talking about, when you say 3-1-1, 3-year initial term plus 2 1-year extensions, would you say most of the buyers of real estate over the last 2-3 year period who use bridge debt, would that initial 3-year period be floating rate or fixed rate?
Floating rate debt, I think, for the most part, right? And hopefully people have bought interest rate caps, right, to hedge. But some people I know haven't purchased interest rate caps, and some people bought 2-year caps versus 3-year cap, and so there will be look, there's going to be, for some people in the next year, there's going to be a pretty some hefty check that someone's going to need to write to extend their cap or buy a new cap, and or if they go to refinance, maybe the proceeds aren't going to be as high as when they initially got in, because a lot of people were putting 75-80% or even higher on the loan. So I think in a lot of groups that I talk to on the equity side, they're waiting for that to come up, and really be more opportunistic in the way they function.
So you capitalize deals both or have done both models, syndications and joint ventures, where you use either a private equity company or a family office to provide 90-95% of the capital. In the conversations that you're having with your equity partners, where are their heads at now in January of 23? Because like you said, we all thought that they took the summer off, and people didn't go on like 1 or 2 week vacations. They went on like 6 to 8 week vacations in Europe, and just finally got out after COVID and working their asses off. And we all thought after Labor Day, like a typical fourth quarter, we would have a transactional volume that was a normal fourth quarter of hectic deal flow and year end, and it wasn't anything like it. So it was almost like Groundhog's Day, where they were all groundhogs. They looked up, they saw their shadow, and they went back into hibernation. And so, what are your equity partners saying to you?
Everyone's kind of, you get the one side of the fence where everyone's saying, oh, we're still looking for deals, but we're being, the bar is a lot higher. And I think a lot of those people just don't know what they're looking for just yet, and really just kind of just testing, seeing what's out there. But everyone's saying, look, it has to be an incredible deal where it just makes absolute sense to do it now. If not, we're going to kind of be patient, and the bar is extremely high, right? Or some of the larger groups, they'll flat out say, hey, we're probably not going to do anything in Q1. We may start to get a little bit more active in Q2, and just let the dust settle. And I think to your point was that is the time where hopefully the Fed is going to say, hey, we're taking our foot off the gas here, right? So institutionally, and even the guys that have a ton of dry powder, everyone's just kind of in a wait and see mode. And again, unless it's a property that just is an absolute no brainer that's on Main and Main, and an asset that you have to absolutely own, I think no one's really getting excited about anything right now.
So one of the ways, or one of the key metrics that people like yourself sort of justified buying real estate in a low cap rate environment was rent growth. And we saw significant rent growth from obviously 21 to 20, and even the first half of 22, or most of the year of 22 compared to 21. How's rent growth looking in all of your markets? I know it's market to market specific, but sort of generally on your portfolio.
Yeah, Florida is rocking. We haven't seen any slowdown at all.
Wow.
Lease trade outs are incredible. The growth is great. We have seen some slowdown in markets like Phoenix and Vegas. And look, I think Phoenix was expected, right? You just had the rent growth there was tremendous. It couldn't have, gone on really much longer, I don't think. And I think there's some short-term worries there with a ton of supply coming online, right? But I like the space that we're in because new product we're not really competing with there. But look, I think operationally and fundamentally overall, the fundamentals are strong, right? For multifamily, again, a couple markets you're seeing a little bit of pullback, but again, Florida, we're still very bullish on.
What other so you have Phoenix, Vegas, Florida, any other markets that you guys track?
Yeah, we're in Dallas. Dallas, you're seeing, still, there's rent growth, but not like it was. And Atlanta, I'd say, is flattened a little bit. Mm-hmm. And it's hard to say how much of that is seasonality right now versus market conditions. We'll see kind of how things transpire as we get out of the slow leasing season.
All right, so let's take our audience back to the days where you were. What was your position? Small forward.
Small forward, man. 3 guard.
Small forward, 3 guard, Florida State. So what were those years, like early 2000s?
No, so I graduated high school 05.
Oh shoot, you're so much younger than I am. Okay, so mid to late 2000s.
Yeah, so it was like 06, 07. It was one summer. I was there for a summer. It was the time of my life. Florida State, obviously, lot. It was a fun school. Let's say that. And,
you always caught yourself. This is PG podcast here. I have a podcast after dark where we could talk about the days in Tallahassee.
Definitely a fun school. Had a blast. It was an incredible experience. I was studying pre-med. Micro and molecular biology was my major.
Wow, you are much smarter than I ever thought you were.
Nah, all those brain cells are all gone now.
Because of those fun nights.
Yeah. So, but I was studying to be a doctor, and I actually ended up dropping out of college my senior year. Got into kind of an argument with my dad at the time, and then somehow stumbled into real estate a couple of years later.
before we get into that, because at 5'7", I just would love to know what it's like to dunk a basketball on a 10-foot rim.
Well, imagine dunking on an 8-foot rim. It's just a little bit.
I hope I can do that, but I'm 47, but with Jewish hops. Although I was a college baseball player.
Oh, were you?
Yeah, you didn't know that?
No, I didn't know that.
Yeah,
Where
at Northwestern.
Oh, good for you.
Yeah.
Okay.
So back in the day, in the mid 90s, late 90s.
Makes sense why you're such in shape. It all makes sense now.
And well, same with you. I mean, all right. So what was your first job in real estate?
Well, so I didn't have one. My first job in real estate was buying my first duplex.
So you went from, deciding that you didn't like the sight of blood and being a doctor, and then just rolled up your entrepreneurial sleeves and said, let's give this real estate gig a try.
Yeah. So I actually, when I dropped out, I ended up becoming a server at Red Lobster. It was my first job out of college. And then from there, I moved back to Orlando, worked at a restaurant called NBA City. And then from there, I got a job at a call center selling vacation packages, like 2-day, 3-night, the press one campaigns you get, 3-day, 2-night stay at Hilton. So I was doing that, ended up being really good at it, and then started my own company doing the same thing. Started saving up a little bit of money, and then my dad was like, hey, look, you should start investing in real estate, and that's how people build generational wealth. So I hit up one of my best friends that I grew up with, and he found me a $20,000 duplex in Lakeland, Florida. It was at a short sale in 2013. And
wait, it was 20,000 in total, or was that the equity?
In total. It was a complete, rundown. Cabinets were missing. I mean, it was just shell almost. And so bought that place, and in total, fixed it up and sold it for like 150 grand. And I probably maybe put in 10, 15,000 into it. So that was my first deal. And then bought the couple of deals next door to that. And the goal was to get to $10,000 of passive income a month. And then the business just kind of took off.
Wow. This is similar to the Keith Wasserman story of Gelt, who started.
Yeah, I love Keith's story.
Yeah, I mean, you're the taller East Coast version of Keith Wasserman, who started in Bakersfield in like 2009 with a fourplex, and you started with a duplex in, what was it, Lakeland? You said
Lakeland, Florida.
Yeah,
bunch of orange groves.
Okay, so no different than Bakersfield. So what was the point in time where you felt like this is more than just, I don't want to say a hobby, but like that this could be a career? The deal, like going from a duplex to a fourplex to some deal that was like, now I can do it. Now I can make a living.
Yeah. So, it was probably in 2015. I bought a place. It was kind of a smaller deal. It was $1 million deal, and put in maybe a couple $100,000, and then the market just kind of 2015 to 2017 really changed. Sold that, and I was like, well, I don't need to keep doing my day job anymore, and I want to keep focusing full time on this. And the deal started getting bigger. I moved to LA. And then just met some people, some guys that and really just changed my outlook and how and what kind of deals I was looking for, and really just said, hey, this is the market's great. We've had a couple great exits and have done really well, and really needed to start focusing on this full time and just build my relationships, both on the broker side and the equity side, and really try to scale this. So I'd say that happened really like 2016-ish, was right when I moved to Los Angeles.
What was it? Why did you move to LA?
So really it was lifestyle. I'd never been to Los Angeles before.
Yeah, but you're in Florida. I mean, I would say most people who move to LA are, from more colder weather
So I'm from Orlando, Florida, by the way. It's not Miami. Everyone thinks Miami when they say Florida.
Yeah, but why not just go an hour south to Miami versus
So you know what?
hours?
Everyone always says this, like, "Hey, you're Indian, right? Like, and you're from Florida. You should be okay with the heat." I'm like, that's not the case. I don't like the heat. I don't like the humidity. I hate it. I came to LA and I was like, man, I didn't know this existed. I didn't know there was a place in the world where there was no humidity, right? And I'd never seen mountains before, so I was a huge Lakers fan. So I went to a Lakers game and looked around. I'm like, man, this is where I want to be. And called my wife and I was like, hey, we're moving, and that didn't go over so well. So it took a couple of years of convincing, but now we're here.
Yeah, well, that's great. I mean, just listening to you, it's remarkable that it was only 5 years ago, 5-6 years ago, 2016, 2017, that you moved here. You had done some deals, and then to go from the move to now having over $1.5 billion in assets. I mean, do you ever just stop and take a moment and soak it in and just reflect on what you've accomplished in such a short period of time? Plus you had COVID that really, took at least 6-9 months out of the market. So you really did this in a 3-4 year period.
Yeah, man, it's incredible. And it's funny you say that, because I was just having this conversation the other day. You definitely got to stop, appreciate what we've been able to do. And, obviously I want to do a lot more and I think we want to continue this growth, but very grateful and blessed to have been able to have the trajectory that we've had in such a short period of time. I mean, really, if you think about it, it's all happened within the last 2 years, right? Before that, we'd only done a couple of deals a year. And so very, very grateful and try not to take it for granted, what we've been able to accomplish here pretty shortly.
So how would you, someone who's in your position, who's starting out, going from, smaller buildings, even, 7-figure buildings, to then making the jump to a mid to high 8-figure building where you can't use syndication money, you've exhausted friends and family, you really need like a $20-30 million equity check. How did you crack the code in getting into the institutional private equity capital world, where it's a catch-22, where they don't want to give money or invest with people when they don't have the track record with other JV providers? So how can you even get into the door? I mean, that's a common question that a lot of my younger clients, I guess, would ask me.
Yeah, so it's funny because our first deal was it was a deal you guys actually did our legal for. That was our first institutional deal, I asked you for a bunch of recommendations, right? But
Sure.
it's funny because that is the case. Everyone you call, they're like, "Look, you don't have a track record. You don't have experience. Well, how am I supposed to get a track record and experience if no one's going to give you a shot?" It is a catch-22. I would say the first and foremost, most important thing is the asset, right? Because you can go out and put your name out there, but you need an asset to pitch. I think you have to have a live deal, right? And that has to be a great deal first and foremost. And I think that should be the case of all the deals that you do. But it's got to be a deal where it's almost like we were talking about earlier, a no-brainer, right? Especially if you're lacking that track record, it's got to be a home run, right? Guy has to have a great story. And then I think in addition to that, we got lucky, not lucky, but I guess lucky. But even though we didn't have a track record, I had just made my first 2 hires, right? So the first 2 hires that I made was asset manager and director of construction management. And both of those 2 hires that I made had lots of experience. They were institutional caliber teammates, and they had, worked at companies that had over 20,000 units. So they brought the experience that I lacked, right? Which helped them get comfortable. And I don't know if you remember, but in our term sheet with that group, that deal was in Atlanta. And they actually put in the term sheet that I had to spend 2 weeks a month in Atlanta at the deal, because that's how concerned they were about us not having boots on the ground and this and that. And, they took a bet and the bet worked. And, but it's hard, and I think before that, you have to, at least, even if you don't have an institutional track record, it is important to post some wins with your syndications, right? So you gotta, have some sort of exits, and you can show, hey, we know what we've gone round trip. Yeah, look, but I have found that it's easier to raise, $20 million than it is $2 million. So
Totally.
yeah.
I say this all the time, that it's much easier to do a deal that's larger than smaller. There's more groups who need to put out a lot of money, and that's why I think, going back to our original conversation as to where are institutions today on their thoughts with respect to the market and why they're taking a pause. If you look at, really, other than that 3-6 month period of COVID in 2020, from the end of the GFC, let's call that 2011, 2012, all the way through the second quarter of 2022, that 10-year period has been some of the most robust years in the economy in general, and specifically in the multifamily industry. And more money globally has gone into U.S. real estate, U.S. multifamily. So they've done so well that they didn't want to make a mistake in the second half of 22. They allocated the entire year of 2022. A lot of these private equity groups allocated their entire year's worth of capital deployment in the first 2 quarters of 2022, maybe even first quarter of 2022. So they didn't have to transact. And so they're waiting for that market to change, but they're going to have to transact because they're set up to transact, and they've raised so much money that if they don't transact, there's risk of redemption.
Well, and that's the thing, is that I think the difference between now and the GFC is that there's so much capital in the market, right? This is it when it changes, and I think when people finally feel comfortable to jump back in, we're going to have a wave of capital flow back into the business and the industry, and I think that naturally is going to bring pricing back up. But yeah, I agree. I think there's just so much money out there, and even when talking to all these private equity funds, they're out there raising the largest funds right now that they've ever raised, right? So they're in the middle of raising, the biggest funds they've ever raised right now. There's going to be more liquidity than there ever has been, and yeah, I mean, everybody we've known in the industry, they have put out, their entire goal. It was like end of 21, right? That Q4, no one wanted to do anything because they had put out so much money already. So for again, there's no rush right now for anyone really, because everyone's done so well.
Yeah. And speaking of funds, I mean, just our firm over the last 6 months, we've done more fund formation in the last 6 months than we've done probably in the last 6 years, where groups are wanting to be ready and primed so that when there is price discovery again, they're ready to pounce. That's why I think the pain and the blood in the streets, I don't know how painful it will be, because there's so many groups ready to pounce. I think it depends on the asset class. In office, there's going to be pain because there's not that much capital wanting to go into office. In multifamily, you still have a lot of money throughout the world that wants to be in U.S. multifamily.
Yeah, and I think even then, like, a lot of these groups are raising pref equity and have pref equity vehicles out there. So even if there's a need for cash in refinances, there's going to be rescue capital for those groups, right? So I think for a lot of people that are waiting for all this pain, I don't think it's going to be as much pain as people think or anticipate, right? There may be some, but I don't think it's going to be few and far between.
Yeah. So what do you do with your days? I mean, are you constantly looking at deals? You're talking to brokers, you're talking to investors, the transactions aren't there, but like, how are you taking, what are you doing in these days, in the last few months, to I guess, be prepared to transact?
So we're really focused on operations right now, and my days have shifted from I'm still talking to brokers, still looking at deals. We want to keep our finger on the pulse of the market and see how things are moving. And you're not going to see that unless you're underwriting deals real time. But really, right now, it's operations, right? Because we've got to make sure now more than ever that asset management is on point, that we are operating every asset to the best of its ability. Because look, we also have done short-term bridge debt, and we want to make sure that we can hit our debt yields to extend if we need to, and those things are important. And make sure, again, right now that because I think for a long time, a lot of smaller players have gotten by because the market was again, the cap rates were compressing. They weren't necessarily good operators. I think right now you're going to be able to distinguish who a good operator who's not, right? As rent growth starting to taper off, right, and you're seeing some of the main drivers kind of slow down. Key operations are going to be very important.
Are there any markets that you haven't been in that you think this may be a good time to start transacting in once things open up?
Yeah, we've been wanting to get into the Carolinas, Mountain West, Pacific Northwest. Just we're demographically driven, and we brought on an acquisitions person from Kennedy Wilson beginning of last year to handle the West Coast and hopefully start doing some more deals here. And so, yeah, definitely a lot of markets. Utah, Salt Lake City, really like Albuquerque, Columbus, Ohio, I really like as well. So definitely would like to get into some new markets and continue growing the portfolio.
When you mentioned that equity provider who almost gave you your first shot, at least on larger deals, and they wanted to have you be in Atlanta for 2 weeks a year, what's the conversation like when you're in LA and in Florida and you've got people both, Southern California and Florida, and you are doing deals in Texas, possibly Carolinas, Mountain West, Phoenix, Vegas, and you're not there. And of course you can hire property managers that are boots on the ground, but how do you answer the question of why should I invest with you, Zamir, when there are groups that are closer to the asset?
Yeah, we get that often, especially as we've broken into new markets, right? Like Phoenix, I remember our first deal in Phoenix, that was the biggest knock is, look, you guys are a Florida group, most of your deals have been in Florida and Texas. You've never done a deal in Phoenix. And there's so many groups out there that love this market and, operate at a higher level. Why should we do it? And, I think it's, again, the deal really matters, right? The deal's got to be a phenomenal deal, especially if it's your first one in that market. And then, what we did is we hired boots on the ground, right? So we would say, okay, well, Phoenix was close enough to LA, and we hired an LA-based asset manager, and it's only an hour away, so we can justify that. Or Atlanta, that deal that we bought there, we had our asset manager lived in Atlanta, right? Texas, we hired a Texas-based person when we got into Texas. So for us too, it's like if we're going to get into a market, we're not going to just do one deal there, right? It's going to be we're going to go deep, and we're going to commit resources to be there. So if it's an hour flight, our LA-based team is well equipped to handle it. But if it's more, we'll probably put someone on the ground.
Yeah, I guess the last question before move on. Would you say it's going to be more challenging to get the equity to open up or the debt to open up in order to transact?
It's a good question. So, I mean, look, I think debt's there, right? If you're okay with agency right now, and obviously, and I think what happens is you're much lower leverage, right? So you're 55, 60%, which really just for returns, it's not great, right?
Yeah.
So that takes out a lot of players that need kind of 20 plus IRRs, which
Sure.
We've been spoiled these last few years.
But don't you think those groups that require more than a 20 or at a 20 or high teens even have to come down? Otherwise, how can they transact if leverage is always going to, or not always, but it's going to be for the near future below 60%?
They're not going to do deals, I think, or it's going to be, again, like this really distressed deal, right? Where you're going to do it. I think, yeah, naturally people's return expectations should come down. And look, I think anybody who's advertising that they've done 30 IRRs in the last, which we all have, right? I think everyone's IRR track record over the last couple of years is phenomenal. You just can't. There's not going to be that. I don't think that's going to be the case for the short term, and you should be fine with that, right? I think as long as you can portray and relay that. Look, we don't expect to hit those types of returns, but look, a mid to high teens IRR, that's probably reasonable, achievable, and realistic.
Yeah, we'll see. I mean, it's. I think even when you were buying in a low cap rate environment, I always felt that there were certain equity providers whose return expectations were too high that they weren't able to transact because of it.
Yeah. I mean, even today, I still hear people say, we're looking for north of 20s net to the LP. Like,
yeah.
How are you going to get that? You're basically telling me you're not doing the deal, right?
Right. And even with the cost of construction, it's going to be hard for them to do it in ground up.
I agree.
All right. We're going to pivot to the lightning round.
The lightning round
question and answer of Real Talk. So quick answers to the following questions, and then we'll get you out of here. Okay. So if you weren't in real estate, what would you be doing? I already heard potentially doctor, potentially like a manager of a Red Lobster might be in there.
I would. I'd probably
player.
Still be doing the vacation package thing.
Oh, that's right. What was your go-to line that made you an expert salesperson in vacation packages?
You just got to go for the close. You got to ask for the money. So after, you got to, the number one thing is shut up. First person to talk loses, right? So you don't say anything after you're done. Let the next person say something, and then ask for the money. So I'd always be like, do you want to put that on a Visa, MasterCard, Discover? And then I wouldn't say anything. And then then the objections would come out,
I love it. God, we could do a whole podcast on you could teach a sales course. The age you dunk a basketball on a 10-foot rim.
I was 16.
Okay, I thought you were going to say earlier, but no, 16.
I was really goofy and uncoordinated for a long time. I was 6'4" when I was 14. I was 6 foot when I was 11. So I was really tall, and then I stopped growing at 16. And then finally, really didn't grow into my body until I was 16, 17.
The reason why I don't drink coffee is because I'm convinced that there's still a late 40s, almost 50 growth spurt. So I'm hoping to get to 5'7.5".
See, I don't drink coffee. It's probably explains that.
Yeah, so neither do I. So it helped you, but didn't help me. How about best basketball player that we've heard of that you played with or against?
So I played against Dwight Howard.
Whoa.
In high school. Actually, Amari Stoudemire is probably the best person that I played against. He's a buddy of mine now. But I was my freshman year in high school. It was summer league. They put me in it was a summer league game, and put me in Amari. They were up by 40 points. Put me in the game. I was maybe 150 pounds, 6'4", right? And Amari just point guard throws up an alley-oop from half court. Amari comes out of nowhere. His head's a foot over the rim and just dunks all over me. That was my welcome to playing against a grown man moment. It was a senior year. He was number one in the nation that year. That's when I quickly realized that I probably don't have a future in this sport.
Oh, I mean, I remember him on the Phoenix Suns, and that guy, it was just incredible to watch him jump. And as a Jewish person, I'm very proud that he's probably the highest jumping Jewish person since he converted to Judaism.
100%.
Yeah, definitely one of the top 5 Jewish basketball players of all time. Maybe probably top 1. You can be a net buyer or net seller in 23.
Probably a net buyer because, again, I think we're not going to sell stuff unless we have to. We're hoping that rates come back down in the next, couple of years, and hopefully that means cap rates come back down. So if we can keep deals, we probably will.
Yeah. All right. Last question. Best advice someone's given you.
Best advice someone's given me. It's a great one. I've gotten so much good advice over the last few years. I know this is lightning round. look, I think it's just stay humble, stay hungry. Just get out there, be the hardest working person. It doesn't matter how successful you get. Always be humble. You're not better than anyone, and just keep working hard. I think if you want it bad enough and you outwork a lot of people, you're gonna end up getting it. It may take a little bit, but just keep working at it and be consistent.
Well, I love that. I mean, I love hiring. I'm a former athlete. You're a former athlete. I love hiring athletes. I love working with athletes because we all have that same mindset where this is, we're so used to just being driven and going to practice and working on our craft. And now it went from the ball field or court to the real estate industry or legal industry. And I just love seeing your success and the growth of ZMR, and can't wait to see what lies ahead over the next several years. And just congratulations, man.
Thanks a lot, man. I really appreciate it. It's always a pleasure working with you and becoming your friend over the last few years. And thanks a lot for everything you do too, man.
I appreciate it. Thanks for coming on to the Real Talk. And that's another episode. Thank you.
Thanks.
Bye-bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsch. You can catch prior episodes at www.sklarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and sharing this show with others.